What if the tax bill you're afraid of isn't really a tax bill at all? I'm serious. Two people can be the same age, sell the same kind of investment, both make a profit, and one may owe federal capital gains tax while the other may owe nothing. That's how confusing this gets. A lot of older adults hear one sentence like, seniors are exempt from capital gains tax, and it sounds wonderful. But that sentence by itself is not the real rule. I make these videos because too many older people lose money to confusion, stress, and bad timing. If that sounds like you or someone you love, subscribe and stick with me. My goal is simple: help you avoid the kind of money mistakes that feel small in the moment and expensive later. Maybe you're one kind of viewer, you've had a stock fund, a rental lot, or a family home for years, and you've been afraid to touch it because you think the tax hit will be huge. You've been carrying that worry around for a long time. Or maybe you're the other kind. You just sold something, or you're about to, and now your stomach is tight because you suddenly realized, wait a minute, do I owe tax on this and did I already mess it up? If that's you, take a breath. This is fixable. Here's the hidden truth. Most people do not overpay capital gains tax because the rules are secret. They overpay because they use the wrong rule. They confuse age with income. They confuse inherited property with gifted property. They confuse a home sale with an investment sale. Or they look at the sale price and forget the starting value. That's where the money gets lost. And none of that means you were careless. It just means nobody sat down and explained this in plain English. I'm glad you're here. I write these talks the same way I'd explain this to a parent, an aunt, or a neighbor at the kitchen table. No scare tactics, no fake loopholes, just the rules that really matter and the next step that can actually help you. So here's what we're going to do today. We're going to clear up the biggest myth first. Then we'll walk through four things that decide whether you may legally owe little, a lot, or nothing at all in federal capital gains tax. We'll also talk about what to check before you sell, what papers matter, and what simple move can save you from finding out too late. Let's clear this up first. There is no blanket federal rule that says once you reach a certain age, capital gains tax just disappears. Turning 65, 70, or 75 does not, by itself, wipe out tax on a profit. If anybody told you that, they left out the part that matters most. The real rule is this: long-term capital gains can be taxed at 0%, 15%, or 20% for most people, depending largely on your taxable income, not just your age, not just your gross income, your taxable income. That's the number after deductions are taken into account. And that one detail changes everything. Let's say Mary is 72. She gets Social Security, a small pension, and a little income from a savings account. Her taxable income ends up fairly low after deductions. She sells a mutual fund she has owned for many years and makes a long-term gain of $12,000. Depending on her filing status and where her taxable income lands for that year, that gain may fall into the 0% federal capital gains range. Now let's take Robert. He's also 72, same age, same kind of mutual fund, same $12,000 gain, but he also took a large IRA withdrawal that year, and he had more taxable income coming in from other places. His gain may not be in the 0% range. He may owe 15% on some or all of it. Same age. Very different result. That's why I want you to be careful with broad claims. A lot of seniors do pay zero federal capital gains tax on some long-term gains. That part is real, but the reason is not age. The reason is how the tax rules line up with their income, deductions, filing status, and the kind of asset they sold. There's one more piece here that trips people up. Long-term and short-term are not the same thing. If you held the asset for more than 1 year before you sold it, that's generally long-term. If you held it for 1 year or less, that's generally short-term, and short-term gains are usually taxed like ordinary income. That can be a very different bill. So if you bought shares in March and sold them in November, that is not the same as holding them for several years. The tax treatment changes. And for retirees who move money quickly after a market swing, that detail matters more than they think. Your action step for this first part is very simple. Pull out your most recent tax return and look at your taxable income on Form 1040, not just the total money that came in. Then look at the asset you sold or plan to sell and ask one plain question: is this a long-term gain or a short-term gain? Start there before you do anything else. Now let's turn to the home, because this is where old stories keep floating around for years. A lot of people still repeat an old over 55 rule about selling a home. They heard it once, it sounded important, and it never left the family conversation. But today's main home sale rule is not built around age. It's built around whether the house was your main home and whether you meet the ownership and use tests. In plain English, if you qualify, you may be able to exclude up to $250,000 of gain if you're single, or up to $500,000 if you're married filing jointly. For many older homeowners, that is the real reason a home sale ends up with no federal capital gains tax, not because they are seniors, because they qualify under the home sale rule. The basic idea is simple. You generally need to have owned the home and lived in it as your main home for at least 2 out of the 5 years before the sale. Married couples have a few extra details inside that rule, but that's the basic frame most people need to understand first. Here's why this matters so much. Let's say a married couple bought their home years ago for $220,000. Over time, they put on a new roof, remodeled the kitchen, replaced the windows, and did other major improvements that added real value. Let's say those bigger improvements came to $70,000. Later, they sell the house for $700,000. A lot of people look at the sale price and panic. But the sale price is not the gain. You have to start with your basis, which usually begins with what you paid, then gets adjusted for certain things like major improvements. Then you look at selling costs. Only after that do you begin to see the real gain. And then, if the home sale exclusion applies, some or all of that gain may be excluded. That is why two homeowners can sell for the same price and end up with very different tax results. One kept good records and knows the true basis. The other forgot the improvements, forgot the selling costs, and ends up thinking the gain is far bigger than it really is. And let me say one more important thing here. Repairs and improvements are not always treated the same way. Fixing a leak is different from adding a room. Repainting a wall is different from a major remodel. You do not need to become a tax expert overnight. You just need to know that the history of the house matters. If this part already untangled an old story you've heard for years, stay with me, because the next section is where a lot of families overpay without even realizing it. Your action step here is to make one folder before you sell a home. Put in your original closing papers, records of major improvements, and your final sale documents. If you don't have everything, start with the biggest items first. A missing roof receipt from 12 years ago may matter more than a can of paint from last spring. Now let's talk about one of the most expensive mistakes older adults make with capital gains, and it often happens during a hard season of life: inherited property. This one catches widows, adult children helping parents, and families handling old stock, land, or a home after someone dies. People use the wrong starting value, and that one mistake can make a gain look much larger than it really is. In general, inherited property gets a new basis based on its fair market value at the date of death, or sometimes another estate value if that was properly chosen. That sounds technical, but the plain English meaning is this: you usually do not start with what the person paid for it 30 years ago. Let's use a very simple example. A mother bought stock decades ago for $8,000. By the time she dies, that stock is worth $90,000. Her son inherits it. A year later, he sells it for $94,000. A lot of people would look at that and say, well, the profit is $86,000 because she only paid $8,000. But that is often not the number that matters after an inheritance. If the inherited basis is generally reset to the value at death, the son's gain may be closer to $4,000, not $86,000. That is not a tiny difference. That is the difference between a manageable tax issue and a completely wrong one. And here's where people get burned. Sometimes the tax form from the broker does not tell the whole story. Sometimes it says the basis is not reported. Sometimes the family uses an old notebook number. Sometimes a grieving spouse is just trying to get through paperwork and signs off on whatever looks close. Please don't guess. If the asset was inherited, the date of death value matters. The estate papers may matter. The executor may have the number. The broker may have part of the history. And if there was a tax return for the estate, there may be paperwork that helps support the value used. This is also why you should never assume gifts and inheritances work the same way. They do not. I'll come back to that in a minute, because that difference alone can save a family from a very bad assumption. And if you've ever stared at a tax form and thought, this doesn't look right, but I can't prove it, you're not imagining things. Sometimes the most important number is the one missing from the paper in front of you. Your action step for this part is simple. Before you sell inherited property, ask for the date of death value or the estate valuation paperwork. If you already sold it and the basis looks wrong, gather the estate records and have someone review the return before you assume the number is final. Now let's get to the strongest point because this is where timing can quietly turn a good plan into a costly one. A lot of retirees focus on the gain itself, but the gain is only part of the picture. The rest of your year matters too. IRA withdrawals matter, Roth conversions matter, pension income matters, dividends matter, other sales matter. Even the month you sell can matter if it changes what else you do before year end. Here's a true-to-life example. Linda is retired and widowed. She wants to sell stock with a long-term gain of $40,000. In a quiet year with modest taxable income, that gain might create little or even no federal capital gains tax. But in the same year, she also decides to take a very large IRA withdrawal to help a child. And she does a Roth conversion because a friend told her it was a smart move. Now her income picture is very different. That extra income can push some or all of her long-term gain out of the 0% range and into a higher rate. And if her modified adjusted gross income gets high enough, some of that investment income may also face the 3.8% net investment income tax. For a single filer, that threshold starts above $200,000. For married couples filing jointly, it starts above $250,000. So the problem is not that she sold the stock. The problem is that she made three separate money moves in 1 year without looking at the full picture together. Now let's look at the better version. Instead of selling first and hoping for the best, Linda runs a simple tax estimate before she acts. She sees that doing everything in 1 year creates a bigger bill, so she spreads the sales over 2 tax years, trims the size of the IRA withdrawal, or changes the timing of the conversion. Same assets, same life, much better result. That is what smart tax planning usually looks like. Not a loophole, not a secret, just timing. There's one more trap here. If you have a large taxable gain, you may also need to think about estimated taxes. A lot of people are used to withholding from a paycheck, but retirement income and investment sales do not always cover tax the same way. Then the bill shows up later, sometimes with a penalty, and it feels like the system came out of nowhere. It didn't come out of nowhere, it just wasn't checked in time. So your action step for this part is this. Before any big sale, run a full year estimate. Include the gain, your IRA withdrawals, any Roth conversion, dividends, pension income, and anything else large. If the numbers look high, ask whether you need to change the timing or make an estimated payment. Do that before the sale if you can, not after. Let me give you 2 bonus points because if you stayed this long, you deserve the part people often miss. First, do not forget old capital losses. If you had losses in past years and you did not use them all up, some of them may still be carrying forward. That means an old loss may help offset a gain now. A lot of older adults forget this because the loss happened years ago, maybe during a market drop they'd rather not think about. But tax losses do not always disappear just because time passed. And if your losses are bigger than your gains, there is also a limit on how much net capital loss can reduce other income in a year, with unused loss carrying forward again. That can be more helpful than people realize. So if you had a rough investment year in the past, don't assume that page of your return is ancient history. It may still be working for you today. Your little bonus action step here is to check last year's Schedule D carryover information or ask your preparer one very plain question. Do I still have capital loss carry forwards I can use? That one question can be worth real money. Second bonus point, and this one is a warning. Do not assume that giving appreciated property to your child makes the tax issue disappear. A gift and an inheritance are not the same thing. With a gift, the old basis often carries over for gain purposes. In plain English, if you bought stock for $10,000 and it is worth $60,000 now, handing it to your daughter does not usually erase the built-in gain. She may receive that problem right along with the gift. That is why families get surprised. They think, we moved it to the kids, so now it's taken care of. Maybe not. Inherited property often follows one set of basis rules. Gifted property often follows another. If you remember nothing else from today, remember that sentence. It will protect you from a very common and very expensive misunderstanding. So let's bring this whole thing down to one simple message. The real issue is not whether seniors get a magic age-based exemption from capital gains tax. They don't. The real issue is whether the right rule applies to your situation. A low enough taxable income may put a long-term gain in the 0% range. A main home may qualify for a large exclusion. Inherited property may have a very different basis than you think. And timing can either protect you or cost you. That's why this matters. When people get this wrong, they often pay tax they did not need to pay, or they panic about a bill that was never going to be as bad as they feared. And both of those outcomes steal peace from people who have enough to worry about already. So if you do one thing today, do this. Pick the one asset you're most concerned about right now and write down four things on one sheet of paper. What it is, when it was acquired, whether it was inherited or gifted, and what other big income events are happening this year. That one page will make your next conversation much smarter. And one thing before you go, please share this video with one person who may need it. Maybe it's a sister who just sold a house. Maybe it's a brother helping with an estate. Maybe it's a friend who keeps saying, I'm too old to figure this stuff out. They are not too old. They may just need the right explanation. In the next video, I'm going to show you the quiet difference between ordinary income and capital gains in retirement, and why mixing those two up can affect not just your tax bill, but the choices you make all year long. If you want less confusion and fewer expensive surprises, I'll see you there.